Well, it has begun. The goal of the Fed to inflict pain on you is actually in place right now. So what we're going to talk about today is what the Fed's doing. And so in today's context, I'm going to let you know when the Fed's next meeting is, the expectations on what we expect from them or to hear from them, and what they've done so far, put in place, how that's affecting the markets. So that's what we're going to talk about next. So what we want to discuss is what the Federal Reserve is doing what their plans are on and how they plan on inflicting pain on you and businesses. Okay, so basically the goal of the Federal Reserve is to keep inflation in check and keep full employment, but we're working on the inflation front right now. So what we monitor here is when the Fed's going to do what they're doing, how are they going to do it, and what are the results of that? So we know by the Federal Reserve calendar that they have a meeting coming up on September 20th and 21st. So that's just 2 weeks away. So we're prepping to figure out what are they going to do at that time? Are they going to continue to raise rates on an unprecedented level that they've never really done in history? Because this will be about their fourth or fifth time this year of raising rates. And how much do they plan on raising those rates? So to find out and figure out these equations, what we really have to do is dig in on the details. And to do that, what we want to look at is what are they really focused in on? Well, we know Federal Chairman Powell came out and said households and housing is the one big detriment of this country. And they're trying to really curtail that. And I'm going to show you how mortgage rates have basically spiked to the highest we've seen in decades as a result of their actions. But let's focus in on the overall inflation numbers. So this is the CPI numbers, and I'll show you where I got it from. I got it from the U.S. Bureau of Labor Statistics. It's right on your screen. I didn't make it up. And when you scroll down, the numbers here kind of just jump out at you. Look at the area that most is reflective in the CPI numbers, the consumer price index, how much inflation we're feeling as consumers. Well, you see it on the energy front. So let's kind of dive in on the energy piece of the puzzle, the one big piece of the puzzle. I know natural gas is running, the natural gas prices are running up, but what do we all use on a daily basis to get our products basically out of the ground, the raw materials produced, brought to the place where we buy them? How do we buy them? We all use gasoline. Okay, so what is oil doing? Because as you see on the screen, it's the biggest piece of this puzzle. Well, over the last several months, from May to now, we're going to see where oil prices have gone from about $120 a barrel to currently $84 a barrel. That's a 30% reduction in that one item alone. So if we have the biggest component of the CPI number, it's retracting by 30%, what's going to happen to the CPI number? Okay, so I'm expecting the CPI number to come much lower than where we have been, and probably where it is expected. And I'm going to go over the economic calendar next week because the CPI number comes out next week. But let's go over to how the Federal Reserve is doing this. Well, on the mortgage front or the housing front, mortgage rates are basically at the highest rates that we've seen in 4 decades. And I'm going to show you where mortgage rates are today. We just basically matched where we were just a few weeks ago on the highest level at that point. Then we retracted, and then we're on our upward trend again, because again, Federal Chairman Powell is trying to inflict pain on everybody, especially households. So now we know that they're meeting. Now we know kind of where expectations are in the inflation piece of the puzzle, at least the CPI. Now, what is expected from the Federal Reserve for next week or on the 20th and 21st? The expectations from the market is an 85% chance that the Federal Reserve will raise rates 0.75%. So basically we know now when they're meeting, how much they're expected to do, and then what they're actually doing to cause rates to keep going up and up and up. So let's go over to why you're here. Why are you here? Well, you really want to know what's going on with mortgage rates, and that's what we're doing right now. So you can see right through here, it's kind of scary. About 3-4 weeks ago, rates were at 5.25. Now we're at 6.25, basically a 52-week high and the highest they've been in decades. So this is that. What's going to happen? Okay, so let me give you my expectations of what's going to happen. The Federal Reserve is going to step in. They're going to raise rates 75 basis points. The CPI number is going to come in. It's going to come in actually pretty good. So the Federal Reserve, they want to be more aggressive, okay? So they're going to keep raising rates. This time they're going to do 75 basis points. I expect in the next meeting, they might even do 50 basis points. And then from there, I'm saying it's going to be all hands off. Why? Well, that's when everything is starting to compound or can come together to basically validate that a recession is here or right on the brink of the horizon. Okay, so what the Federal Reserve, if you watched my video just the other day, and I'll put a link down to that down below, is I went over history and I showed you basically 10 events that happened in the past times where it was war, pandemics, Asian flu, whatever. What happened in every one of those instruments or every one of those time frames? Well, the Federal Reserve stepped in and they tried to help things and they overspent like they did this time. Then the Federal Reserve said, whoa, inflation's running rampant, so we have to go in and do what we have to do. They drove up rates every time, and then almost every time, I would say about 7 of those 10 events, within months, the Federal Reserve had to pivot and reduce rates because they overshot it and the economy was getting crushed. Okay, so I expect that's what we're gonna see. So Q4 of this year, and Q1 of 2023 would be my time on when I'd look to get back into this market. Would I be a buyer right now? No, I wouldn't be a buyer right now because I just don't like the markets. I don't like what's happening. I just don't like the uncertainty. Unless I had to really move, I wouldn't be a buyer right now. I would wait to see when the new inventory or more inventory came in, and I'm still expecting a rate reduction within the next 6 months. So that's where I stand on those events. So the next piece of the puzzle, what's happening in the MBS market to kind of give us a crystal ball of where I see rates going. Well, they're up 16 basis points. So what that means, this is the price of a mortgage-backed security bond. As this price goes down, rates go up. Well, you're seeing in this case, it's going up. So that means rates are coming down. So I'm going to see rates about 6.2 by midday and maybe by the end of the day, and then where we would go from there. And unfortunately, in today's world, it's whatever the Fed decides to do. So that is my report for today. So I hope you like what I have to present. Just to let you guys know, guys, I am not a realtor. I'm actually a mortgage advisor. So if you're in need of a mortgage anywhere in the country, I am federally chartered. I'd love to help. To find out more about me and my team, all you have to do is go to therateupdate.com. You're going to find all our information there. So God bless, guys. Thanks for watching. Take care, and I'll see you tomorrow. Bye-bye.